Hello, everyone, and welcome to the Emerging Manager Growth Show, Episode 5. I'm joined by my partner, Dan DiDomenico. Dan and I have worked together since 2008. He's our president, and this show is dedicated to all emerging managers, an opportunity to have a forum to ask questions. We're going to share information. As if this is your first episode, we have covered in the past RAs, emerging manager programs within RAs. We have covered consultants, emerging manager programs and consultants. We've done a generic, just emerging manager programs. And then we have also done the public funds, all the leading. So all those past episodes have all that information about all those different emerging manager programs. We go pretty deep. Today's gonna be a fun one, Dan. We're gonna go into banks and BDs. And kind of when I was looking through the outline, I was getting pretty excited because it's a channel that we've been trafficking in, home office, FA teams for quite a long time.
Correct.
And it's an unbelievable channel. So we're going to dive in. Now, a couple things that we're going to cover. First off, if you all don't know us, very short intro to who is Dakota. So we're a firm that was founded in 2006, and we're a third-party marketer. So investment firms hire us. We've had very long-standing relationships. So 06, 2009, 2015, 2018, long-only equity managers generally, as well as we're now working with 2 private fund managers. We started a database business to compete with the likes of Preqin, Discovery, RA Database, FinSearches, et cetera, and have over 700 firms now subscribed to that business. So that's a separate but related business. So we're here to share what we know and information on emerging manager programs within the banks. Now, Dan, before we get going, it's obviously we're coming off of a wild 22, and this is our first episode for 2023. Can you just share with the group, you're on the road every week talking to people all day long, allocators, just give us the general tenor that you're seeing out in the marketplace today.
Yeah, I mean, like when you come out of these types of environments, a lot's happened, right? And so the level of communication and transparency is at an all-time high, it feels like, right? Because everyone needs to know, how did you perform? What changes were made, right? So coming out of this, and you recall coming out of 2008, when we went through that episode of extreme volatility, you end up talking about that time period quite a bit for years to come. So it's not only what did you do during that time period, but now reflecting back on it, what lessons did you learn, and now being able to reference that in future conversations. And I will say the level of activity, people taking meetings, wanting to know within those meetings, the opportunity set that you see in front of you, right? There was a lot of cash buildup last year. That makes sense, right? You had a period where you wanted to become more defensive. And now that period of, all right, I can't be sitting on cash forever. How am I going to put that cash to work? And so it's a really good time to be talking with people.
Great. And so they're receptive to meetings?
Very receptive.
Right. So if you're an emerging manager, you have no brand, right? Now, we've grown up with no brands in our firms, and we've tried to make them well-recognized brands in the marketplace. So the whole message to an emerging manager from this show is, how do you do more with less, right? Well, one thing that you can control is your communication, right? Do you want to talk a little bit about that, Dan? Because we're chronically like crazy communicators. We don't want anybody to have 1 minute of wondering what's going on with Edgewood or Hamlin or Spyglass. Hardman.
Well, that's that extreme transparency that we were just talking about, right? And what you want to be able to articulate to people very clearly is who you are, what you do, and what people should expect. No one's going to expect for you to outperform in every single market, but were you consistent in your discipline to performing the way that people thought that you should perform? So last year, obviously a really challenged year for growth. We've seen a bit of a recovery in that over the last 3 months. So how has the portfolio been performing when it should perform? So that's the kind of communication that you want to get across to people, because we all know these asset allocators, they're creating programs, allocating to a variety of strategies. How do they all work together? What's your role? What's your utility within that portfolio? And can you back that up with the numbers?
Right, and so in some cases, our audience today might have a lot of fundraising experience, but maybe it's a bigger firm now working with an emerging manager. It might be where you're a portfolio manager and now you're kind of carrying a marketing hat. You can't communicate enough, because remember, anytime that you're speaking to your client or your prospect, they're going to take that content and they're going to share that with their clients. You're actually supplying your clients and prospects with useful information so they can communicate what's going on in your portfolio. One big secret we've had for emerging managers, Dan, is getting familiar, right? So one of the most important things for an emerging manager because it's free. But communication is free in terms of it might be your time writing or doing a quarterly call, but you want to create familiarity. So again, back to an emerging manager, we're assuming maybe that not everyone on this call has deep fundraising expertise. The whole goal in fundraising is to create familiarity, and you can control that. You can control what you say. And you got to put a lot of time into thinking that through. We have so much documentation and content around how you create that familiarity about your strategy. Just want to talk about, I know we're talking about extreme communication, but one of our managers, okay, I just want to share it with us, it's pretty cool. 16 years we've been working with Edgewood Management, okay? Still not an emerging manager per se, but they were when we started with them. We always did a quarterly conference call. We demand quarterly conference calls. In fact, on this call, we can follow up with our quarterly conference call ebook. So we did a full ebook on a quarterly call, how you do it, how you set it up, everything, the why behind everything. We had a monumental moment this quarter, right? Last year was a rough year. They came into this studio and they pre-recorded their quarterly call. And Jamie Sims, God love him, did all of the editing over the weekend because it was time consuming to get done, or we were time constrained. But we take communication seriously, talk about what it was like to work with Edgewood, because for everybody, it's going to be like, oh man, do it. I mean, you can do a webinar, you can do a conference call, but you should be doing something each quarter.
Yeah, and it's the delivery of it, right? And that's what Edgewood decided in this quarter, and I give them a lot of credit and wanted to do it via video. Now, obviously, they had this as the space and the resources to be able to deliver the webinar in that structure. But that video, the feedback that we're getting is just off the charts because people, they want to not only hear and be able to listen to the updates that we're providing, but they love the on-demand feature of it, right? Being able to pause, take notes, hit play. But it's also the familiarity that you're creating now, right? They're able to watch and see the portfolio manager sit around the table, this desk right here, and be able to go through, hey, here's what happened, challenge years, here are the portfolio decisions that we are making along the way. Here's what the quality of the portfolio that we see here today based off of the moves that we've made. And that connection that you create via video, it's just really hard to replicate that in any other structure in a scalable way.
Yeah, and so tell them about we just heard today, how many requests did we get from clients?
We had over 500 requests for that video.
So there you go. So it's an investment of time. I know it's trying to get ramped up, but if you're not doing, and this is part of our show here, is giving advice. And so one of the advice is either conference call, webinar, or video live, the whole thing, just to communicate. And then make sure, as part of when we send out the ebook, there's always a transcript that's created that you want to be able to send out afterwards. You want to send out the recording, the transcript, and then you need to summarize the transcript in an abstract so it's really easy for someone to have the key takeaways from the call.
Yeah, I mean, what you're trying to create is a consistency of the experience, right? So if somebody is going to go and invest their assets with you, they need to know that they're going to be consistently communicated to in a manner, in a way that makes their lives easier, right? We talk about it all the time as a team. How can we make the life of the allocator, the one that's going to be making that decision, how can we make their life easier? And that's just one way that we go about it, is by creating a lot of content, but delivering it in a lot of different ways, knowing that the person that's consuming it may have different preferences.
And Dan, why we do this show every month is we want to make sure, because it was happening too often, emerging managers were calling me and I'd take the call and everything, we'd update them and such, but we need our industry needs a forum to ask questions, debunk myths. We're going to go through a bunch of myths around the banks and broker-dealers today. You can put questions in the chat on the right-hand side. We do have a question, Dan, that I think this is kind of a good way to kick it off, and we'll get into the banks. Are high net worth individuals and family offices as receptive to investing with emerging managers versus institutional LPs, public plans that may have policies, projects to promote investing in said managers?
Absolutely, they are. I mean, when you think about all the competition out there just in the U.S., multifamily offices, family offices, RIAs, they compete with one another. And they want to create programs when they're sitting across the table from their client that's differentiated from something they may have seen at another competing RIA or multifamily office. I'd say they're the most receptive to emerging managers, boutiques, where they can really differentiate themselves. They're going to do all the due diligence. There's no shortcuts in that whatsoever. but they are very thoughtful, they're independent, and they are the ones that are trying to compete differentiated portfolios so they can compete with other RIAs and multifamily offices.
And then when you're thinking of this, think of emerging manager programs as one thing, one opportunity at all the different places. And then think of you as an emerging manager, which really means you just don't have the resources. You don't have the sales team. You just don't have the budget necessarily to do certain things. So you have to do more with less. Yep. And what we're encouraging you to do on this show is we're showing you and talking to you about the different tips and techniques that you can do to create a fantastic fundraising infrastructure without breaking the bank.
Right? Being effective and being efficient.
Right, yeah. Exactly. So why don't we dig in, Dan? Yep. We have right now probably $15 billion that we've raised over the course of the past 15 plus years through the banks and broker-dealers. We're almost on every single select list with one of our products, and so we know this channel extraordinarily well. And why don't we just dig in? Do you want to get into the myths?
Sure. Yeah, I was going to say, and we've been able to do that without a 50, 70, 100-person wholesaling team, right? I think that's one of the biggest myths out there, is that you need a massive sales team to be effective at the wires, the BDs, and the banks. We've always looked for leverage points within these systems to drive asset flow from the top down. But I would say one of the bigger myths out there would be you can't call on these BDs or banks until you hit certain thresholds, especially around AUM.
Right.
So we had called that out and said 500 million in assets, whatever the number is that you have in your mind, that you need to wait until you hit that key milestone in AUM before calling a BD and bank. First and foremost, we would break that one down and say, absolutely not. Right? You want to be calling on the central research teams, the platforms, the gatekeepers to these platforms as soon as possible. Get on the radar. Start building your brand. Start telling your story. And you just don't know in certain cases, and we'll call out those that will create emerging manager programs within their platforms, that it could connect and they could move a lot quicker than you would otherwise expect.
Yeah, and I think the key is we're not guaranteeing that if you send an email to try to get a meeting that you're going to get the meeting, right? But you have to try. You have to be out in front of them. We believe the fundraising strategy for an emerging manager, and it depends upon your type of your product structure, what have you. We're typically mutual funds, separate accounts, working with Spruce now, construction loans, that's a mortgage REIT. The goal is to make sure that you are in front of all the key RAs because they have discretion and they really like to find up and coming, off the run investment strategies. No guarantees, but it's sales, right? So you got to get in front of people. It's a full contact sport. You got to send the emails. We're going to get into exactly what the email should say. Subject line, body, clear call to action. We'll talk about that. And then on a parallel track, you want to list out. Now we've made it easy in Dakota Marketplace. I know I'm singing our book, but in Dakota Marketplace, it has all the key contacts at the banks and broker dealers. So you have your total addressable market already identified. You just have to construct the email, send the email, and do that very consistently. So Dan, the win, just holistically, right before we get into it, the win with a bank broker dealer is central research.
Yeah, go central research, right? Because the win is going to be a select list or an approved list, right, where you can have an elevated status amongst all of the other options on the platform. The second win, really the holy grail of what you're trying to pursue there when you really are thinking about leverage distribution within one of these big platforms, are the asset allocation models that are created. We've always taken that approach. We used to say back in when I joined in 2008, Guy had already had this philosophy around where is it, how can you create the win without being transactional, having to go into and wholesale into the offices, and really competing with wholesalers on a day-to-day basis and knocking on office doors and doing the whole lunch meetings, things along those lines, that is far more transactional. Back then, we did it more because we found that that model is really not sustainable, and it's played out that way. Yeah. Meaning these BDs, these banks, these wirehouses, they become far more centralized in creating model allocations, really taking a lot of the discretion away from the FAs, bringing that in-house, and creating these products and models. That's the ultimate win, is when you can be plugged in to one of those models. It's a very efficient way of raising assets at one of these really large financial advisor-based firms.
Okay, so this is a great question, okay, because it gets to value. So how do you balance being consistent with communication without annoying a prospect? Okay, so the most stark example that we had was during COVID. All the small caps, everything was getting killed, but small caps were really getting killed. And people were saying, oh, you know what, I'm not going to be doing any prospecting until the fall.
Right.
And this was the perfect time to get insight from your portfolio managers around small cap stocks, whether it's value, core, growth, and then reach out and say, not trying to sell your product, trying to say, I'd love to give you some insight or share with you some information about what our portfolio managers are seeing, because I think there's a lot of myths out there on what's actually happening at the underlying company level. So if you're following up in that way, where you're adding value in that way, sharing insights, that's not being annoying, that's adding value. So if all you're trying to do, right, is sell your product and get an allocation without adding value first, a ton of value, a ton of insight, that really brings out the true value of your investment strategy, right? Because the more knowledgeable you are to, you can show for your portfolio managers to your prospects, then that's not annoying, right? Or just giving them updates. For instance, AUM updates are very, very important. Don't assume they're watching your strategy on a daily basis, right? So it's just dripping on them, and then it's trying to, hey, I'm going to be in town in 3 weeks. Can you meet? That kind of thing.
Be very direct with a call to action, brief in your email. What is it that you're asking for, so they can quickly respond? And I'd also say, we talked about this on the Dakota Live call where we profiled JP Morgan more recently. Just be thoughtful and prepared in how and when you're reaching out. They put out publications around their market outlook, and we know JP Morgan can be fairly opportunistic around what they're seeing, what they believe is going to play out. Well, how do you fit into that? Right? So take the time. Go onto their website. The Eye on the Markets is all available in there. Read it. How do you factor into their outlook? That's just one way that you can gain their attention. That's not annoying, but it could offer some insights into what they're seeing in connection to what it is that you're doing.
Exactly. So another question along those lines, do you need a mutual fund to penetrate the bank BD channel? And why don't you go through generally, as we'll turn the page, as we generally look at the banks and BDs, because we're starting to see a lot of success. We have mutual funds, we have separate accounts, but obviously UMA.
Yeah.
So why don't you just talk about, you don't need a mutual fund. And by the way, being like, our goal always has been, right, to get 3 to 5 RA wins a year, right, and then 1 to 2 platform wins. And if you kind of stack that up over 5 years, you end up with a pretty darn good business just in these intermediary channels.
The growth of model delivery and UMA programs just continues, right? So the way that we talk about it with our underlying managers in understanding before you make that call, what are the various platforms and needs of that potential BD or bank, and do you have the right strategy that can port well into the various structures that they may use? So I wouldn't say you have to have all of them right away, meaning separately managed account, model delivery, and mutual fund. We're starting, and we're keeping a very close eye on the launches around active ETFs, semi-transparent, some non-transparent. We're keeping a very close eye on that, but for the time being, really focusing on those 3 legs to the stool. I would say that you don't necessarily need the mutual fund right away. To start the conversation, to even be effective, if you can offer your strategy in SMA and in particular UMA, that's a great way for you to get into the system, to be able to more actively sell your strategy, tell your story, and it may come to where that BD or bank, that platform, could serve as the end demand before launching a mutual fund, right? So, we sometimes call it as a means to an end, right? You're going to barter a little bit in offering up your strategy, maybe at a lower minimum and a lower fee by participating in a UMA program. But if you can look at that as a way to get in and then be able to grow with that BD and bank by offering up other vehicles and strategies as you launch them, using that UMA as the spear, it's a great way just to get into the system.
Yep. So don't just need a mutual fund. There's really 4 ways to win: ETF, mutual fund, separate account, UMA.
Yep.
And Dan, why don't we dig in, because we're trying to define what an emerging manager, it does vary all across the industry, everything. But it's probably not a $10 million, right? That's not an emerging manager. It's much more of a startup.
Yeah.
Emerging manager would be, sort of north of 100 million, 150 million, depending, 200 million, up to, some people cut it off at 2 billion, some at 5.
Callan's 3 billion.
Yeah.
Yeah. So
So
it all depends. Some will look at number of employees, length of track record. Those are all factors that they'll look at in defining what could be considered emerging. Some even use some DE&I qualifications and factors when thinking about emerging manager programs that maybe they're looking to build out.
yeah, and I think one takeaway is that you really don't want to overthink it, because there's opportunity everywhere.
Yeah.
Right. You really have to be in the numbers game of sending the emails, city scheduling, booking meetings, and never stopping. As I always say, it's like, if you want to be a successful fundraiser, you better get very comfortable with being a professional meeting setter-upper, right? You just have to be firing emails, picking cities you're going to travel to, circle 9 o'clock, 11 o'clock, 1 o'clock, 3 o'clock, 4:30, and just start trying to book meetings with a very clean email, clean subject line, one sentence, and a clear call to action. Can you meet May 26th at 1 p.m.? ?
And to that point, it's not just essential research teams either, right? We've always taken on parallel tracks, talking not only to the central research, but also trying to generate the demand, right? I'm not telling you should spend all your time trying to call on individual teams within one of these BDs or banks or wirehouses, but selectively, especially if you're going to be in a city, why not call on one of the corner office, the larger teams within Morgan Stanley? It could be a Greystone team or a PWM team, because if they connect and really gravitate to what it is that you're doing, they're going to be the ones to help you get prioritized by essential research, acting as that source of demand.
Yeah, and since inside of our database, Dakota Marketplace, it has all of the qualified banks and BDs with the proper people, then you just have to make it your mission to make sure that all of those firms, right, that you're in front of every single one of them on a consistent basis, and then just listen to see like what comes out of those, because you just never know. You got to be making the sales calls, because you can't be a mind reader.
Absolutely. And I think, Guy, if we're just going down here, one of the other things to be mindful of, and we covered this on one of the prior emerging manager growth shows here, was talking about consultants.
Yep.
And there is a lot of blurred lines and overlap, right? So even talking with the consultants, knowing that there are a few of those that work very closely in support of the central research teams at these BDs and banks. So there is some crossing of the lines. I always think of Callan IAG, right? And having the IAG group that's specifically designed for supporting advisory groups out there that would have wealth management platforms and programs. So there's a lot of, if you're talking to a consultant, that may also lead you into the wealth intermediary channels of RIAs and the BDs and banks.
Right, because each one of them, UBS, Morgan Stanley, Merrill Lynch, they all use a consultant.
They do, yeah. And they're not outsourcing all of it. It's to supplement and to complement what it is that they're doing internally. So if you have a recommendation, or you've been working really hard and you feel as though you got a great relationship with Fiducian, right? Well, then you should know that Fiducian has a massively growing end market of RIAs and BDs and banks that they're working with. Corio being one of them, the old RSM, where they rely a lot on Fiducian. So if you're going to be working that through Fiducian and you're successful, all right, so what are those second sales and calls that you could be making adjacent, or just understanding who their client base is?
Right, and someone just asked a question about LP. Absolutely, banks and BDs will use LPs, no doubt, but there's so much going on there, from whether it's quarterly tender fund, a traditional LP, the closing date, if it's an open-ended fund, closed-end fund, that all plays into it.
And many of them use iCapital or a case, so there's a lot of that support and technology from those programs and platforms. So if you have an LP, you have to be in conversation with an iCapital or a case.
No doubt. And we did do a segment, interviewed Lawrence Calcano. It's inside Dakota Marketplace, CEO of iCapital. He went through everything, where all the wins lie and everything. So we have a robust section in Dakota Marketplace on iCapital and case as well. Okay, great. This is a good one. Post-COVID, how important are in-person meetings? Does there seem to be a preference from the home office teams between Zoom and in-person? Well,
look, I'm still a big believer and love in-person. So we put it out there to our team to get on the road, travel. It still forces that issue around city scheduling and making sure that you're covering all those qualified allocators within a certain metro area. I would say from the standpoint of the allocators that you're calling on, it's become a little bit more challenging just because of the hybrid nature of some people being in the office or not. So you do have to pick and choose. And I've commented quite a bit on Dakota Live calls that you have to almost alternate your dates on when you're going to go to Boston, as an example, because you might miss somebody that's only in the office on Mondays and Thursdays versus somebody that's in on Tuesdays and Wednesdays. So you have to be a little bit mindful of that. But I would say there's still no replacement for in-person meetings. They're still happening. I'd say you still get so much out of those connections and building of relationships that you just can't do on Zoom. And we even see it in ourselves. We talk about it, the multitasking that goes on when you're on a Zoom call versus being in person. So I still highly encourage you and still find that setting up meetings and getting receptivity around in-person meetings, we're back up to the activity levels that we saw pre-COVID.
Yeah. And I would also say, as we all know, every single one of us, 100% of us do it. Your attention span is a nanosecond on a Zoom call. As soon as the call goes on, you're on your phone, you're checking stuff, the whole thing. No one's trying to be mean by doing that. Then when you're face to face and having a conversation, it just changes the whole tenor of the interaction. So, great question. Okay, you mentioned a mortgage REIT you worked with earlier. How receptive do you find this bank BD channel to emerging private REITs, especially after your black? So again, to answer that question, right? I just wouldn't overthink it. I'd just make the sales call. I'd just stick out your hand and introduce yourself. This is who we are. This is our investment strategy. Right? Naturally, after Blackstone and BREIT and BCRED, after raising so much money, naturally, right? It kind of went the other way. Like mutual funds can't put up gates, but you've seen mass redemptions of mutual funds. It's no different for that. So,
and you just don't know, there's so much turnover in our business. When somebody new steps in, either into that director of research or now they own that platform or program, you don't know what their agenda is going to be.
Yeah.
And you don't know what the groundswell of demand is also going to be based off of Guy's comments. Is absolutely right. BREIT, BCRED, maybe there's going to be more of an appetite now for more traditional lockup LP type strategies.
Yeah.
Right. Knowing that there's that liquidity aspect of that liability and asset matching exercise that goes on. And you might just have something that you can be able to go out and say, look, for us to be able to implement this and truly express what it is that we're trying to deliver to you and whatever the returns are, it has to be in this type of lock-up vehicle. It's more of a traditional LP. So again, I would just, to Guy's point, just turn your brain off, make the call, you just don't know.
So the goal, is not to raise money. The goal is to be in a current sales cycle with all of these targets with your strategy, because you just don't know.
Yep.
You just want answers, right? You just can't have the unknown, and you can't, like I always say about portfolio managers in video, they basically, before they shoot it, they want to know the answer. They want to know the test score they're going to get on the test before they take it. And unfortunately, in video, you can't do that, and in sales, you can't do that. You have to be in a current sales cycle with feedback over time from that platform, from that RAA, from that bank, from that BD, whatever it might be. Also, InvestNet, from a bank perspective and BD perspective, is super, super powerful. So from a separate account perspective, UMA, that's another great leverage point, because the banks and BDs do leverage InvestNet quite extensively, and a lot of the smaller banks do as well.
Yep.
So that kind of, they'll probably, when you call them, they'll probably say, hey, are you on InvestNet?
Yep.
So another good, and by the way, we have so much information on InvestNet in Dakota Marketplace, unreal detail on that platform. We've probably profiled it 3 or 4 times over the course of the past 3 years on the show, or on Dakota Live.
Yeah, and we've had speakers from InvestNet join us as our guest allocator. Director of research joined us. We also had head of product join us as well. So all that content is available in Marketplace.
So we had another question for engaging with large consultants. So we're going to go through. So Mercer, Callan, IAG, Wilshire, Fiduciant, Goldman Sachs, Rocaton, Siegel, Marco, Conway. They're the ones that we know work.
Yeah, that's the
bank
subset. That's probably the largest ones. Even like a Morningstar has their own institutional consulting group. So that's another one that works a lot with the BDs and banks as well.
This is a great question here. For engaging with large consultants, is it best to go direct to the pension fund, to the field consultant, or the research team? It's really all 3.
Yes, it is.
Yeah, you got to hit all 3. And like I said, this is a game, right? This is a game of touches, and you're just constantly touching. So you're reaching out, trying to get the institution on the line, introduce yourself, try to get a meeting, have a conversation. and they'll tell you right up front, right? The more direct they can be, the more direct you can be with them, asking good questions. Hey, we've never met before, we've never had a relationship. This is who we are, this is what we do. What you really want to do is just take their temperature and say, hey, I'd love to learn about your platform. It seems that you invest in our types of strategies. Because within Dakota Marketplace, we have over 32,000 public pension fund holdings. So you can get a pretty good view if you just go into Dakota Marketplace who invests in your type of strategy. We have over 150,000 ETFs at the RIAs, banks, and broker dealers by asset class and sub-asset class. So you can get a pretty good feel who are the largest allocators to your type of strategy even before calling them.
Yeah, and when you can make that reference point, again, you're trying to close that gap of them not knowing who you are, but very quickly having familiarity. And if you can reference sell to them and say, here's the category that we're in, you likely have investments with XYZ firm, right? Immediately now they know where they would potentially bucket you. And that at least helps on the front end for them not only having familiarity now with who you are, but immediately connecting on where it is they could potentially place you in the portfolio.
Yeah, I don't think of fundraising as a sales job. I think it is getting answers. Like your goal is to get answers, which is really like once I get to know you and I know you invest in my strategy and the whole thing, like once you go through it, is there an opportunity, right? Is there an opportunity this year? Is it next year? Is there never an opportunity? You're looking for answers. You're looking to be in that flow of information. And like Dan said, there's a lot of turnover amongst the analyst ranks, about 25%. So just because you got an answer 3 to 6 months ago, just touching base, because someone might have left, new person comes in, they knew you from a prior life, all of that. So if an emerging manager has a small level of investment to make to market their firm strategy, where would those dollars go? So considering we've been doing this, it would go to a database, right, of a complete database of intermediary institutional investors, so you don't have to do all of that research. And then the investment really is in a salesperson who's going to city schedule, always have 5 cities on the calendar, making those sales calls against the relevant channels. And hey, I'm going to be in St. Louis, and here's one sentence on who we are, what we do, make it really compelling. Can you meet May 26th at 3 o'clock? So that's where the money should go, right? Because you want to save time, and you want to make sure you have a complete set of investors, because you never know who's going to take your meeting. Money's green all over, right? I mean, we have all different types of people, right? Not necessarily all brand names that are investors, right? All types of people. You want to be calling all the people that buy what you sell. And that's what we really tried to do with our database business, because we've lived it, is we're always just trying to find matches. We call it product market fit. We're trying to find matches for the strategies that we manage to the investors that we know invest in those strategies.
Yeah, then where you start finding momentum, go deep into that channel.
Best sources of investment for startup hedge funds. I definitely would say, again, a database, because you need a database of investors to make sales calls. And in that situation, depending upon how startup you are and then what your pedigree is, all of that, RAs would be the best place to go. If you're kind of a low asset base, 10, 20, 30 million, hit the RAs first. You can complement that on a parallel track with the banks and BDs, but hit those RAs. We have so many investment preferences in Dakota Marketplace. You can know who invests in hedge funds. We also have in Dakota Marketplace, which is really cool and very unique, is we have a checkbox for LP power user. So because we know on the ground who are truly the LP power users, and there's no publicly available information on that. That's not proprietary. It's just they happen to invest in LPs in size versus other RAs.
Yeah, I would just add the institutional consultants dedicated to emerging managers.
Yeah,
and hedge funds. Yep, for sure.
And the good news is if you're a startup hedge fund, everybody knows, right? Foundations and endowments, this is the time to invest with you. Because in general, your best returns are in your first 3 to 5 years.
Yeah.
Right?
Yeah, people think about that for sure.
Okay. Let's get down to, you want to talk a little, we've covered a lot, even on our...
Yeah, I guess one other point of advice that I would give, especially if you have this ability, those early investors, how to attract them. Is there some way that you can work through around the table with, if it's a BD or a bank, preferred terms, right? And what is it that you can do for them to separate yourself, relative to them coming in early versus them potentially coming in when you're much more mature and at scale. So thinking about preferred terms, in some cases it does work, and Raymond James comes to mind, where we've been effective here with them in giving them a matter of exclusivity for a period of time. We've done this with some of the larger institutional consultants as well, where we've given them a certain time period where those preferred terms and staying exclusive to them, that may sunset at a certain point, and those are all terms that you can negotiate up front, but just being creative with them, right? It could be around performance fees, it could be around just lower management fees, and certainly trying to work in how you could be exclusive to them for a certain period of time. That's been a way to get their attention and potentially get them acting quicker and moving forward with you versus waiting for that 3-year track record and $500 million in assets.
So we just got a question. So Susan, here's your answer. The question was, off the top of your head, which are the best conferences for emerging managers? For example, startup hedge funds. So here you go. It's all inside of our Dakota Marketplace. We have 400 or 500 conferences. We highlight conferences that are dedicated to emerging managers. Here's a nice list for you, and then yet to be announced. So we've been working really hard on our conference database business, and we've been filling that up pretty extensively. So here are the upcoming conferences for emerging managers. You can screenshot that, or we'll send it to you. But that was a wonderful question. It's pretty darn funny that you asked that, because that was our next segment. So, and that wasn't even teed up by our team. Now it's just that truly came from the audience. Okay, could you touch on cadence of email follow-up for meeting scheduling, in person and virtual? Okay, so my favorite topic, okay, because you can't raise money if you can't get a meeting. You only can get a meeting via email. So email is the holy grail. So what we like to do is always schedule 3 weeks out. We always want to have 5 cities we're scheduling for at any given time. Mm-hmm. We always, on those cities, we have 9 o'clock, 11 o'clock, 1 o'clock, 3 o'clock, and 4:30. It's perfectly fine to double book, and then you say, hey, someone hits you for your 9, then you say, hey, can I move it to 11 or 10:30, and that whole thing. But it's generally 20 to 25 emails a day. And I would say if you get a couple of meetings, you can convert to virtual. If you're planning on going, you have the budget and the whole thing. I would also, depending upon where you're located, I would make sure that when driving distance kind of thing, if you're an emerging manager, your startup hedge fund, what have you, you can go meet locally in your car. A lot of hedge funds are obviously in New York, Philly, Boston, and that's chock full of literally hundreds of RAs that are dying to hear from you. I'm not saying they're dying to immediately make an investment, but they want to know what's out there. They want to, they're a source of investment ideas. If you're not getting responses, right, you want to tweak your email. If you want to send it to me, Dakota.com. Send me the email that you're sending with enough information on your company, and I'll write it for you, and what I would write if I were you, and I'll send it back to you. That's how committed we are to you guys and to our emerging managers. We want to see you guys win. And there are just little things, right? Just you make it a very compelling email. And I'll just say the cadence is very consistent. You want to be very consistent in your outreach, because also what allocators really know is they know if you're kind of a one and doneer, right? You beg for the meeting, you finally get the meeting, right? They're like, fine, I'll take the meeting, and then they don't hear from you ever again, right? It's consistency. It's showing up on a consistent basis. Value-added information, not always just selling your product, insights that you're seeing, whatever it might be within your strategy, sharing that.
Yep. And listen, ask thoughtful questions on the front end, and based off of what you learn, make sure when you're going back in to visit with that potential allocator that you're building off the conversation. That's why you want to take notes, right? Take the notes, capture them in your CRM, so that when you go to that next meeting, you're building off of it. You're not repeating yourself, or you're not going in with the same angle of attack based off, but you learned something in that first meeting that would tell you that you should be potentially working the conversation through a different angle, through a different lens.
The good news is, as we've gone through this, if you just, the through line of our counseling, our advice, our experience that we're just sharing, is almost everything is free. The only tough part is you got to deal with rejection, you got to deal with a lot of work, sending a lot of emails, using a CRM to be highly organized. So the only thing that gives a salesperson leverage, I believe, the only thing that truly gives them leverage is a very well organized CRM.
Yep.
And then if you can integrate that with a database, like Dakota Marketplace or others, that gives you all the fresh leads that are accurate, up to date. And so somebody else is doing that work for you. But keeping your CRM airtight after all the meetings, logging all the meetings that you've scheduled, the notes from those meetings, referencing them on a daily basis. Hey, who did I meet with 90 days ago? Follow up, everything. It can give you 2x, 5x, 10x leverage. I can't recommend it enough. So, Dan, any closing comments? We have the conferences, and then our next show will be February 21st at 1 o'clock. Dan?
Yeah, I mean, like everything, this is a component of your overall sales plan.
Right.
This is one that I think many emerging managers might neglect or deprioritize, knowing that they should be there someday. Just start now. Start getting into the introductions, get into the mix, because 3 years could go quick. The next
3 years goes very fast.
The next thing you know, you don't have a pipeline here, and you haven't started those conversations, and that's just time lost.
Yeah. So make sure you're making the calls. Like I said, the only thing that you should be thinking about is, am I in a current sales cycle with each one of these platforms? Do I have an answer from them on where they would stand with my type of investment strategy? So with that, we'll sign off. Dan, thanks so much. Loved having you on the show.
No, this is awesome.
This is
fantastic.
Great. Everyone,
hope that helped everyone.
Have a great day.
Take care.
Hello, everyone. Just wanted to say thanks for watching. Hope you enjoyed the show. One thing that I think you do know is all of this information that we covered exists in Dakota Marketplace, our institutional investor database. Even this show that we just cut will end up in Dakota Marketplace so you can view it. And if you're not a member, we would love to show you the platform. Just simply go to our website and get a free trial of Dakota Marketplace.